Okay, let's jump into this. You've probably seen it yourself. Crypto isn't, a small corner anymore. We're really talking about serious capital flowing in.
Absolutely. Institutional investors, the surveys are pretty clear, huge plans for increasing allocations in 2025. A lot of them looking at over 5% of their assets under management.
Right, 5% of A for those huge funds is massive. And it's not just them, right? Individuals are piling in too.
Yeah, projections are hitting like 500 million global holders next year. And in the U.S., the average person holding crypto isn't just dabbling. They're putting in, around 14%. That's significant.
It really is. But with that kind of explosive growth comes, well, the need to talk about risk.
Exactly. Risk management becomes critical. And the tricky part is that the usual financial models, the ones built for, say, stocks, they assume things move kind of smoothly.
Yeah, the model's going way back, assuming continuous prices, little wiggles day to day.
Right. But crypto doesn't always play by those rules. It has these sudden, sharp moves, jumps.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, jumps. Now, the idea isn't totally new in finance, is it? People have talked about jumps before.
No, not entirely new. Robert Merton introduced jump diffusion models decades ago, actually, to capture things like big market crashes from unexpected news. But jumps feel different in crypto. More frequent, maybe more fundamental.
And why is that? What makes crypto so, jumpy?
It seems to be a mix of things specific to this market. You get news hitting one specific coin, causing a massive move just for that one. Then there's social media, right? Sentiment shifts online can be incredibly fast and powerful drivers.
Sure.
And the market structure itself often plays a role. Lower liquidity in many tokens, trading split across loads of exchanges. It can just amplify moves when big orders come in.
Got it. So these jumps aren't just blips, they actually change how prices behave.
Yeah, research shows they really do. They affect short-term swings and long-term trends in ways those smooth, continuous models just weren't built for. That discontinuity, that's the core challenge.
So if the old toolkit isn't quite right, we need something new. Which brings us to the main topic for this deep dive.
Exactly. There's this research paper proposing a new way to actually estimate and manage this jump risk and, importantly, how jumps spread contagion.
Okay, so our mission here is to unpack that. We'll dig into the theory they're using, walk through the steps of their strategy, look at what they found, some surprising results there, and, also touch on the limitations.
Sounds good. Let's start with the theory. How do they actually model these jumps? They begin with a fairly standard model, a baseline, to predict daily returns.
Okay, predicting today's price change based on what happened before.
Pretty much. They use what's called a jump diffusion regression, basically trying to find a relationship.
Regression, right. So finding patterns. What are they looking at from the past to predict today?
Three main things from the previous day, typically. The average return over the last couple of weeks.
Like the recent trend.
Yeah. Then the volatility, or standard deviation, over that same period, how choppy it's been. And finally, the trading volume. Log trading volume, specifically.
So trend, choppiness, and trading activity. Makes sense. They run this model, and then what? The part it doesn't predict is the key.
Exactly. That leftover bit, the unpredictable part, is called the residual. And the idea is that's where the jump, the discontinuous move, is likely hiding.
Ah, okay. The model gets the smooth part, the residual catches the sudden lurches.
Right. You used a good analogy earlier, like hitting a speed bump. The model predicts the smooth driving. The residual is the jolt from the bump.
Gotcha. So how do they actually pinpoint a jump within that residual? Is it just guesswork?
No. They use a pretty common and accepted method, a threshold rule, a 3 sigma rule.
3 sigma, meaning?
If the size of that unpredictable part, the residual on a specific day is really big, more than 3 times the typical size or standard deviation of all those residuals.
They call it jump.
They flag it, yeah. A 1 for jump day, 0 for not. Simple binary indicator.
Okay, so if the unexpected move is way bigger than the usual unexpected wobble, it's probably a jump.
That's the logic.
Yeah.
And this lets them measure things like jump intensity, How often do these jumps happen? Just count the ones and divide by the total days.
Right. Frequency.
And they can look at the jump characteristics, the average psi of the variability, by looking only at the residuals on those flagged jump days.
And this straightforward method, just finding the big outliers, it has some theoretical backing.
It does. There's a connection, Theorem 2 in the paper, linking this threshold approach to the idea of jumps happening randomly over time, kind of like a Poisson process. It suggests this 3 sigma method gives a consistent estimate of the true jump rate over time.
Okay, so it's a practical way to capture these discrete events. And you mentioned volume earlier. How does that tie into the theory?
Right. Theorem 1. They theorize and find evidence that trading volume helps predict these abnormal returns, the residuals. Higher volume often goes hand in hand with these big, unexpected price moves.
So jumps often happen when lots of trading is going on.
Yeah, the intuition is they don't happen in isolation. Big trades can trigger jumps, or jumps can attract big trading volume. Seeing that positive link supports looking for jumps in the residuals.
Okay, so we can spot jumps for one crypto, but the real worry for a portfolio manager is when lots of them jump together, right? Systemic risk, contagion.
Absolutely. That's the critical piece for risk management, co-jumps. So they need a way to model how cryptos depend on each other, specifically during these extreme jump events.
Which isn't the same as just normal correlation.
No, it's different, especially for extreme moves. They use tools called copulas.
Copulus. Sounds fancy.
A bit. But think of them as a way to isolate the shape of the relationship between assets, particularly how they behave together during extreme highs or lows out in the tails of the distribution.
Like focusing only on when things go really well or really badly together.
Exactly that. They use specific types of copulas to measure tail dependence. This gives you the probability of asset A having a big jump, given that asset B is also having a big jump.
Okay. And they look at ups and downs separately.
Yes. They measure upper tail dependence, they call it lambda U, for coordinated surges, and lower tail dependence, lambda L, for coordinated crashes.
So ill is the chance they surge together, L the chance they crash together.
Correct. And the theory here, Theorem 3, basically says if these lambdas are significantly above 0, it means these synchronized jumps happen way more often than if the assets were just moving independently. It helps pinpoint contagion risks.
Got it. So not just if they jump together, but the direction too. And they take this further. Quantify the impact.
They do. They want to know how much of the overall connection between two assets is actually driven by these jumps. So they separate the total co-movement, the covariance, into 2 pieces.
The wiggle part and the lurch part?
Essentially, yes. The covariance from the smooth stuff and the covariance only from the simultaneous jumps. Then they calculate jump ratio.
Jump ratio.
Yeah, it's just the jump covariance divided by the total covariance.
And what does that ratio tell you?
Theorem 4 explains its meaning. If that jump ratio is over 0.5, so over 50%, it means the relationship between those two assets is primarily dominated by their jumps. How they lurch together matters more than how they wiggle together.
Wow. So that flags pairs where jump risk is the main driver of their connection.
Precisely. Those pairs are hot spots for potential contagion.
Okay, that's a lot of clever modeling. What did they actually find when they ran this on real crypto data? Any surprises?
Some really interesting findings. First, jumps are definitely not uniform. Larger, established coins like Bitcoin. Fewer jumps, but often bigger magnitude when they do happen.
Okay.
Smaller tokens, altcoins, meme coins. More frequent jumps, but the typical size is often smaller. That difference alone is important for risk.
Right. Risk isn't one size fits all here. What about that initial baseline model predicting returns with the simple factors?
That also showed some interesting things. For some coins where the model fit really well statistically high R-squared, they sometimes saw extremely high coefficients, like a super strong link to past returns or volatility.
Suggesting strong momentum.
Possibly.
Yeah.
But they also caution, especially for low-volume coins, it might just be the model overfitting noise. You have to be careful.
Makes sense. What about the heavily traded coins?
More stable results there. Past average returns seem like a fairly robust predictor for many of them.
And the big players. Bitcoin, Ethereum.
This was key. For those mainstream coins, that simple baseline model was surprisingly weak. Low R-squared values, often under 15%.
So the basic factors didn't explain much of their daily moves?
Very little. Past average return often showed up as significant, hinting at some momentum, but past volatility and volume, often insignificant in that simple model.
Which implies?
It implies that for the biggest cryptos, the standard continuous dynamics are hard to capture with simple factors. The real action, the main driver of returns, might be in that unpredictable part, the residual, where the jumps live.
Underscoring the importance of modeling jumps for them.
Exactly. Overall, the regressions did show volatility clustering is common, past chop predicts future chop, and volume effects are there, but maybe with a lag. The R squared itself becomes a signal. Low R squared suggests a lot of unpredictable risk, likely including jump risk.
Okay. And turning to the systemic side, co-jumps, contagion findings.
They definitely identified specific days, jump contagion days, where a whole bunch of cryptos jump together, often tied to big news events or market shifts.
And the tail dependence. Surges versus crashes.
This was really striking. They found upper tail dependence. The tendency to surge together was significantly stronger than lower tail dependence. Tendency to crash together for many crypto pairs.
Wait, really? More likely to pump together than dump together?
Yeah, particularly among the smaller tokens. For a lot of altcoin pairs, the lower tail dependence, the chance of crashing together, was actually near zero.
That kind of flips the script on contagion always being about downside, doesn't it?
It really does. And they showed how assets with a high jump ratio, where jumps dominate their connection, form these identifiable risk clusters. They get examples like specific pairs with jump ratios over 0.7 showing their co-movement is overwhelmingly jump-driven.
And even between the big ones, BTC and ETH.
Significant jump correlation there too, over 70%. Their jumps are highly synchronized.
Okay, so this is all fascinating insight, but how does someone actually use it? What's the practical payoff for a portfolio manager?
Right, the application. They built a strategy around this. They created a jump-adjusted covariance matrix.
Okay, so it's like the normal covariance matrix, measuring how assets move together, but adjusted.
Exactly. They take the standard covariance and add in an extra component. The covariance calculated only from the jump events, covariance of returns, plus covariance of jumps.
So it explicitly builds in that risk of them lurching together, not just wiggling together.
That's the idea. It gives a more complete picture of risk, especially that tail risk, the risk of extreme moves happening simultaneously.
And they tested this, put it into a portfolio.
They did. They used this jump-adjusted matrix in a pretty standard portfolio optimization method, minimum variance, aiming to minimize risk.
And did it make a difference?
A big one, statistically speaking. The portfolio using the jump-adjusted risk measure had significantly better Sharpe ratios, especially during volatile market periods.
Better risk-adjusted returns.
Yes, and importantly, this held up out of sample, meaning it wasn't just fitting the data they built it on with really high statistical confidence, like 99.9%. Theorem 5 backs this up, showing adding the jump covariance reduces downside variance in stress times.
Wow. So that's pretty compelling evidence. Explicitly modeling jumps leads to better performance when things get rough.
It really validates the approach. It shows this framework isn't just theoretical, it's a practical tool that captures those abnormal dynamics and leads to better risk management outcomes.
Okay, but as we always say, no model's perfect. What are the potential catches?
Definitely important to cover. Like any statistical model, it rests on assumptions. The 3 sigma jump detection. It works best if the residuals, the unpredictable parts on non-jump days, are roughly normally distributed.
So the jumps really stand out as abnormal.
Right. If the non-jump residuals are already really wild and non-normal, the 3 sigma threshold might misidentify things. It also kind of assumes jumps are rare and pop up somewhat randomly, like that Poisson idea. If jumps are actually highly clustered or predictable by factors not in their simple model, detection might be less accurate.
And the baseline model itself, the one looking at past returns, volume.
It's pretty simple. They acknowledge it won't capture the dynamics of every single token out there, especially maybe very new or illiquid ones. It's best suited for assets with enough history and trading activity for those factors to have some meaning.
Data quality in crypto is always a potential issue too, right?
Always. The whole analysis depends on the accuracy and timeliness of the price and volume data they used. Bad data in, potentially bad results out.
And you mentioned those very high statistical results for some low volume coins.
Yeah, that's a flag they raised themselves. Super high R squared or significance on thinly traded assets could just be noise fitting, not a real economic relationship. Requires careful interpretation.
One more, that finding about low crash risk, low LL for many altcoins.
It's intriguing, but interpretation needs care.
Yeah.
It could mean genuine resilience, that these coins don't drag each other down, or it could just reflect fragmented markets. Maybe the investor bases for 2 obscure altcoins are so separate they just don't have common triggers to make them crash together.
So it might not be inherent strength, just lack of connection.
It's a possibility that needs considering.
Okay, so wrapping this up for you, the listener, why wade through all this technical stuff about jumps and copulas? Why should you care?
Because this jump risk isn't just academic jargon. It's a core driver of the volatility and the potential losses in crypto. Those sudden drops or surges, especially when they happen across the board, that's often what impacts portfolios the most.
Right. This research gives you a lens to understand why the simple models struggle and offers specific ways to think about risk differently.
It pushes beyond basic correlation to look at co-movement during the extreme events that really define risk. Identifying pairs with a high jump ratio, for example, gives you a specific flag for contagion risk.
And crucially, the payoff. It shows that actually doing something about jump risk, like their jump-adjusted strategy, can demonstrably improve your risk-adjusted outcomes. It's a more sophisticated approach.
And it highlights that different cryptos have different jump personalities. The risk profile of Bitcoin isn't the same as a small altcoin, especially during these extreme events. So this deep dive really underlines that jumps are fundamental to crypto. Ignoring them means you're missing a huge part of the risk picture. We've seen how researchers are building tools to spot them, measure their systemic effects, and crucially, show that factoring them into portfolio management can actually improve results, particularly when markets get wild. It points towards building more resilient strategies for this unique asset class.
Which brings us to our final provocative thought. We heard that striking finding. Positive co-jumps, surges happening together, seem more common and stronger than negative co-jumps, especially for smaller tokens. So, if that's true, how might you think about strategy differently? Not just playing defense against crashes, but maybe finding ways to strategically position for, or even benefit from, these periods of synchronized upward momentum.
Yeah, does it change how you think about diversification or allocation, especially for different types of crypto assets known to surge together?
What questions does that raise about tailoring strategies, not just for risk mitigation, but potentially for capturing upside contagion? Something to think about.
Definitely challenges the traditional risk-only focus.
Okay, we've dug deep into these sources on crypto jumps and contagion. Hopefully you feel a bit more equipped to understand this crucial aspect of the market.